This video was brought to you by Brilliant. For the past few years, Erdogan has stubbornly refused to raise Turkey's interest rate, despite a collapsing currency and spiralling inflation. Whilst he somehow kept the Turkish economy afloat for an impressively long time, last month Turkey's central bank announced that they were essentially running out of money, and it became clear that a U-turn was now inevitable. This came on Thursday when the new central bank governor raised rates from 8.5% to 15%. Unfortunately, this wasn't enough for the markets, and the lira subsequently slid to a new low of 25 to the dollar. So in this video, we're going to have a look at how things got so bad, Erdogan's U-turn, and why it might not be enough to stem Turkey's economic crisis. Before we start, if you haven't already, please consider subscribing and ringing the bell to stay in the loop and be notified when we release new videos. As we've explained in numerous other videos, the Turkish economy has had a tough few years. Despite a declining lira and spiralling inflation, Erdogan has refused to raise interest rates, because it's apparently un-Islamic and a conspiracy advanced by the so-called interest rate lobby. Instead, he's cut rates and fired any central banker who dared to oppose him, which has unsurprisingly crippled the lira and pushed up inflation. Turkey's official year-on-year inflation rate reached a peak of 85.5% in October of last year, and while it's since fallen to 40% in May, that would still imply prices are up about 150% in the past 2 years, and unofficial estimates put the true figure far higher. Turkey's government and central bank tried various harebrained schemes to bring down inflation without raising interest rates. They started with capital controls, which basically made it more difficult for Turkish citizens and businesses to sell their lira. They forced major exporters to convert at least 25% of their foreign exchange earnings into lira. They briefly floated a new lira for gold scheme, which involved trying to buy under-the-mattress gold from Turkish citizens, and introduced a super generous protected lira deposit scheme, which essentially said that the government would top up any lira deposits to make sure it keeps its dollar value. Assuming the government keeps its end of the bargain, this basically makes those deposits risk-free for ordinary Turks, which is why they've become so popular. Nonetheless, even with all these schemes, the lira continued to decline, which forced the central bank to intervene in the markets. Basically, to keep the lira afloat, the central bank just started buying loads of lira with its foreign currency reserves, which artificially inflates its value and keeps inflation down. This practice, commonly known as defending your currency, really ramped up before the election, both because the central bank wanted to protect Erdogan from an economic crisis to guarantee his re-election, and because investors realised that Erdogan was probably going to win, which made them even more desperate to sell their lira. Turkey's central bank burned through nearly $25 billion in May alone, and nearly $8 billion in just the week leading up to the election. Running out of their own reserves, Turkey's central bank started asking friendly countries for help, including a $5 billion deposit from Saudi Arabia and generous swap lines with the UAE, Qatar, China and South Korea. When this wasn't enough, the central bank had to start borrowing more foreign currency from financial institutions, including some of Turkey's smaller banks, and analysis by JP Morgan suggests that the central bank's net reserves went negative last month. This means that the central bank has borrowed more foreign currency than it actually has to hand, which puts it in a particularly precarious position. This doesn't actually mean they've run out of money yet. They've still got about $100 billion worth of assets sitting around, but they owe other institutions more than $100 billion, hence net negative. Anyway, time was clearly running out for Erdogan. He called in all the favours he had. His central bank was in the red, and a couple of weeks ago the lira was trading at an all-time low of 23.5 lira to the US dollar. With economic gravity catching up with him, Erdogan started paving the way for a rate hike and a U-turn earlier this month, when he reshuffled his finance ministry and central bank. A U-turn will obviously be a bit embarrassing for Erdogan, but, well, he just won another 5-year term and solidified his place in Turkey, and solidified his place as Turkey's de facto ruler for life. So it's not like he's going to threaten his electoral chances. Anyway, the two main appointments here were Mehmet Şimşek, who was appointed finance minister on June the 3rd, and Hafize Gaye Erkan, who became Turkey's first female central bank governor on June the 9th. Both Simsek and Erdogan are what you might describe as darlings of the market. They've both made it clear that they disagree with Erdogan's unorthodox monetary policies, and they've both spent a lot of their careers at big Western banks. Erdogan used to work at Goldman Sachs before becoming co-CEO and president of First Republic Bank, while Simsek headed up the emerging markets division at Merrill Lynch before demonstrating his credentials as Turkey's finance minister from 2009 until 2015. These appointments were clearly designed to signal to the market that a U-turn was coming and that the adults were back in the room. And, well, it sort of worked. In the first few days of June, the lira slipped from 21 per dollar to nearly 24 per lira, but after Erdogan's appointment, it stabilised at that level. After a few weeks, Simsek eventually convinced Erdogan to hand over the reins, and on Thursday, Turkey's central bank finally announced that it would be raising its benchmark rate from 8.5% to 15%, and implied that there would be more hikes to come. Unfortunately for Erdogan and Turkey, this didn't go down well with the markets, and the lira has since slid to a new low of 25 to the dollar. This is because the markets essentially expected a sharper increase, and they don't think that 15% is high enough, given that inflation is still at 40%, which means Turkey still has a large negative real inflation rate. Goldman Sachs, for example, predicted a jump to 40%, and a Bloomberg poll put the median outlook at 20%. This put immense pressure on Erdogan and his new team. Clearly, the markets expected sharper rate hikes, and this is probably the only thing that can halt the lira's decline. However, steeper rate hikes will do devastating damage to Turkey's economy. Take Turkey's housing market, for example. Turkish house prices have skyrocketed recently as Turks look for a safer place to park their depreciating lira, and steep interest rate hikes will almost definitely trigger a house price collapse, similar to what's currently happening in the UK, but more severe. Ultimately, in a sense, Erdogan is reaping what he sowed. He delayed the pain for an impressively long time, but now the house of cards is coming down. It could be really painful. Having just watched an 8-minute video explaining the Turkish economy, it's fair to say that you have a desire to learn and better your knowledge of advanced mathematics and data analysis. Well, we've got something that you might enjoy and will continue your online educational journey. Brilliant. Brilliant is an online STEM learning platform where you can learn everything from quantum computing or algebra to logical decision making. And if you don't want to learn more about the world from simply just watching YouTube videos, then you're in luck, because Brilliant actually teaches you by doing, using active learning techniques to teach you the principles behind otherwise complex subjects, and ensuring you actually understand what's going on. And rather like a good TLDR news video, Brilliant breaks topics down into accessible chunks, which you can work through whenever you have time. There's no homework, there's no deadlines, and there's no core classes. You can spend anything from a few minutes to a few hours a day accumulating new knowledge in an actually fun way. So whether you want to brush up on your basic math skills, improve your employment prospects by learning about future technologies, or just have fun with coding, you can check out everything Brilliant has to offer free for a full 30 days. Click on the link in the description. Plus, the first 200 of you will get 20% off Brilliant's annual premium subscription. Thanks for your support.